Good morning, good afternoon, good evening, and welcome to this RVW Wealth presentation, a timely look at estate and tax planning opportunities led by the esteemed Steve Siegel, who I will come back to in a moment. I wanted to just make a couple of statements. First, the first one our lawyers make us say, and the SEC makes us say, is nothing here is considered to be, and nor is it intended to be, the giving of investment or tax or estate planning advice. These are generic observations that may or may not be applicable to your situation. Before you take any action, please consult with your own professional advisors. We hope we are high up in the list. Always honored to do that, but do not act on anything you see or hear over here. I secondly, at this time of the year, want to pay particular tribute and pay thanks to, first of all, the RVW team, a group of dedicated people who care about nothing more than the highest standards of integrity, ethics, and sophistication to bring to you, our clients. So I want to pay thanks to them, and then, of course, to our clients who entrust us with safeguarding, protecting, and growing their nest eggs, the trust you place in us every day, and the seriousness with which we take that role of stewardship of your nest egg is something for which we're extremely grateful to each and every one of you. And for those of you who aren't clients yet, remember that we're where the smart money ends up eventually, sooner or later, better sooner. Let me now move on to introducing Steve Siegel. Each of you have seen his bio briefly, and I'm going to give it to you very briefly by saying he's a real expert. He has the respect of his peers. He teaches lawyers and accountants and financial institutions around the country, and he's knowledgeable, creative, and a wonderful human being. We've become friends over the years. We've had many opportunities to work together, and to work with Steve is a joy and an honor. And Steve, it is my pleasure on behalf of all of us at RVW and all the people watching this webcast around the world, and many who will be watching it after hours because we've had many requests for replay links. On behalf of all of us, thank you for being part of RVW, for being our kind of counsel advisor, and for agreeing to do this presentation for our supporters, friends, family, clients, and staff. And with that, I hand over to you and welcome you to RVW.
Well, thank you, Solon, and thank you for the very kind introduction. It's a pleasure to have the opportunity to speak with you. And as soon as the slides are up on the screen, I'll begin my discussion. Here we go. All right. Well, our topic today is talking about what we should be thinking about after this 2025 Tax Act, primarily focusing on people of moderate wealth and higher wealth. The good news is the tax rates didn't change. So we still have the rates that are as favorable as we're likely to get. They were talking about raising them during the election, but that didn't happen. And so now for at least the next few years, we have these rates in place. Next election could change things, but for now we are safe in being confident that where we are makes some sense. So that gives us the opportunity to talk to clients about exercising stock options that might be available, that might be thinking about converting to Roth IRAs. And we'll talk more about those things in a few minutes. But the general feeling is with no changes in the income tax rates, these planning opportunities are still with us at rates that are relatively favorable. Investment taxes, once again, no change in the 20% rate on long-term capital gains and qualified dividends. We still have that 3.8% net investment income tax. Those thresholds for married folks, 250,000, singles, 200. They're not indexed for inflation, so they will be imposed. But the highest rate of 23.8% is where we are for the next several years in these opportunities. The standard deduction is somewhat increased. They're making it $31,500 this year, $15,750. That was retroactive to the beginning of 2025. Will people continue to be dominating their tax returns by claiming the standard deduction? It depends. That's been the case of the last 5 or 6 years because of the $10,000 cap on state and local taxes. However, that cap has been removed for a lot of people, and we're going to talk about that in a moment. And because it's been removed, we're likely to see more people itemizing their deductions, which, if you're likely to be an itemizer, that then suggests that your charitable deductions might be more valuable to you than they might have been if you were capped at the standard deduction. So let's talk about one of the biggest changes in the 25 Act, the increase in the deduction of state and local taxes to $40,000 for a married couple, $40,000 for a single person. That's extremely favorable, a big increase over the $10,000 that we had since the 2017 Act became law, and that's effective for 2025. And going forward, it'll be somewhat increased by inflation, but in 2030, it comes back to $10,000. And as we all understand, the 2028 election could change things, continue things, we don't know. But for now, we have a $40,000 deduction. Before everyone gets too excited about that, there's a reduction, and the reduction begins once you have $500,000 of income. If your income exceeds $500,000, here we're talking about your modified adjusted gross income, not your taxable income. This is before you claim your itemized deductions or your standard deduction. If you're over $500,000, you begin to lose the $40,000 deduction opportunity. For every $1,000 that you're over $500,000, your deduction falls by $300, and if you're over $600,000, you get the $10,000 deduction. So what does planning say here? The simple thing to say is keep your income under $500,000, but that's somewhat of a naive suggestion. But if you want to address your income and try to reduce it in a more sensible way, one of the things we recommend is a qualified charitable deduction. You have an IRA. If you're 70 and a half years old or older, this year you can put $108,000 from your IRA to a public charity, not a donor-advised fund, even though a donor-advised fund is considered a public charity. So the suggestion here is you use this qualified charitable deduction to remove funds from your IRA. It's not taxable, included in your adjusted gross income. You don't get a deduction for it, but it reduces your income, particularly for those people who are 73 and older and have required minimum distributions. You can do this at 70 and a half, but you don't have the RMD. But if you have the RMD, the required minimum distribution obligation, and you're 73, you do, this is a way to reduce your income by around $100,000, which might get you below the $500,000 depending upon your situation. So that's one of the things to be aware of. This $500,000 to $600,000 is, let's call it a danger zone. If you're well over 600, there's not much you're going to be able to do to get the increased deduction. And if you're well under 500,000, then up to 40,000 of your state and local taxes will be deductible. So the planning opportunity is to try to get the deduction, but there's more we can suggest here. If your plan is a grantor trust and all your funds are in a grantor trust, a revocable trust like so many of us have as our centerpiece of our planning, you get one deduction. You're the grantor, the trust income is all taxed to you, and you get whatever deductions available. But another planning suggestion is to use non-grantor trusts. You set up a trust for a child. You set up a trust for a grandchild. Maybe that trust is generating income from interest, dividends, gains, etc., that lead to state and local income tax. Maybe you can put some real estate into that trust, which has real estate tax associated with it. Each trust gets its own $40,000 deduction. So what you could do is, if you have multiple children, grandchildren, if you set up one trust for the group of them, you get one $40,000 deduction. But if you have enough deductions that could generate multiple trusts, consider setting up a separate trust for each person. And that way you get multiple $40,000 deductions. And if it isn't the full 40, it doesn't mean you made a mistake. Whatever it is, if it's more than 10, it's an advantage. But another advantage is if you're moving some of your income producing assets into these trusts, your own income may fall below $500,000, which then gives you the opportunity to claim this deduction along with the people that you're benefiting from these trusts. Another change in the law is the deduction for seniors. Because the 2025 Act was passed by what's called reconciliation, it only needed a simple majority in the Senate, but there's a rule in reconciliation that you can't tamper with Social Security unless you get 60 votes, and that wasn't going to happen in this Senate go-around. So they couldn't reduce or eliminate the tax on Social Security, so they gave every person who's 65 or over this $6,000 deduction. So many people will take advantage of this. And the thought was for people at lower levels of income, they would not have to pay any or as much tax on their Social Security. So all a good start. But then once again, we have caps. And so once you're over 150,000 and between 250 on a joint return, you're not going to get the benefit of this $6,000 deduction. You don't have to itemize for this. Married people have to file jointly, but each one gets a $6,000 deduction, and single persons get a $6,000 deduction as well. But again, you're looking at these caps. And so for many people who are fortunate enough to have income well over these numbers, this deduction is not going to be of any benefit. But again, like the other deduction for state and local, if you are in a situation or have family members, clients that are in or around these thresholds, trying to stop before you hit this phase out is an advantage where you might get the $6,000 deduction. A very important change involves charitable giving, and it's not entirely favorable for people who itemize deductions. The first thing to say is that if you make a cash contribution and you don't itemize deductions, you claim the standard deduction, beginning next year, 2026, whether you itemize, if you're not itemizing, you're claiming the standard. If you're a married person on a joint return, you can deduct $2,000 of your gifts to charity, $1,000 for others. So this is a plan that might make some sense, that for people who don't itemize deductions. The thought here is it begins in 2026. So not to sound like someone who doesn't care about charity, but if you have a client who's about to write a check in December to their favorite charity and who does not itemize deductions, maybe suggest to them that if you wait until the first week of January of 26, you're going to get this $2,000 or $1,000 deduction. Whereas if you write this check in 2025, you won't get this deduction unless you're itemizing. So one thought for non-itemizers. Some people are close. They may be itemizing if they have enough deductions, but what often carries them over the standard deduction threshold, particularly if they're high income and they aren't going to get the state and local now that with it's been increased, is bunch your deductions. Let's say you have the desire to give $10,000 a year to charity, but if you do that, you may still get no itemized deduction benefit. Why not make a $50,000 gift, for example, to a donor-advised fund, claim the $50,000 deduction in the year you make the gift, and then have the donor-advised fund follow your instructions and give $10,000 a year to each of the charities you care about. That's another way to try to spread this out. There's a problem, though, with the new tax law. Beginning in 2026, next year, you lose 0.5% of your adjusted gross income from your charitable deductions. You have to reduce your charitable gift by 0.5% of your AGI. So an example would be with $100,000 of AGI, you lose $500 in charitable gifts. $1 million of AGI, you lose $5,000 of your charitable gift. This only applies to itemizers. It doesn't apply to people who are not itemizers claiming the standard deduction. So now let's take a look at some planning. If you're an itemizer, you're better off making your gifts in 2025, because this new reduction of your deduction only applies beginning in 2026. So for the people who are likely to be itemizing and very generous to charity, exercise your generosity aggressively in 25. Maybe you make that big gift to a donor advised fund in 25, which will cover your anticipated generosity for 25, 26, and maybe a few years after that. That way, this reduction only applies to gifts made beginning in 2026. So if you're a non-itemizer and you defer a gift to 26, you're ahead. If you're an itemizer and you accelerate a gift to 2025, you're ahead there. But if you go the other way, the non-itemizers makes the gift in 25, you don't get that benefit, and the itemizer waits till 26, you get hit with this reduction. Another reduction is in the law beginning in 2026, which again will affect all of your potential deductions, including your charitable gifts. What they're doing in this law is they're saying that people who are in the 37% tax bracket, that's the highest individual bracket. If you're in that 37% tax bracket, your itemized deductions are only going to give you a 35% tax benefit. They're reducing it by 2/37 of the deduction that you would otherwise be able to claim. So your itemized deductions are limited to this 35% bracket. And so again, if you're not in the 35% bracket, this doesn't apply to you. But if you're in the 37% bracket, this cap of 35%, so that 2/37 for some people will be a small issue, but for others could be a larger issue because you may have a lot of itemized deductions. And the one that has the most discretion is charity, because your mortgage interest deduction is capped at an investment of $750,000 of debt. The interest on that amount is the cap. The medical deductions only are available at more than 7.5% of your adjusted gross income. A lot of people with decent insurance don't come anywhere near that. So you have mortgage deductions that are capped, medical expenses that may not be deductible if your income is high. You might get the $40,000 state and local, but maybe your income is too high for that. Hopefully no deductible casualty losses. Well, you're left with charity, and charity is the one that's discretionary. How generous do you want to be? That's another reason why the 2025 year is the better year to be making your gifts to charity, because this 2/37 reduction only begins to apply in 2026. So something that's happened is positive. The 529 plans continue to be excellent vehicles. The interesting thing about the 529 is it's about the only thing in the tax law that doesn't have caps. Anyone can contribute to a 529 plan. There's no limit on your income. There's no limit on your AGI, your taxable income, nothing. So now they can be used for more things. They've expanded them from being allowed to be used for the tuition for K through 12 and parochial private religious schools. Now, after July 4th, they can also be used for expenses beyond tuition. So various things that these schools may expect one to pay, you could be used in these situations. Another expansion by this new law, very favorable. If you have a credentialing program, if you're an accountant, if you're a lawyer, if you're a professional that needs to maintain your license, you can use a 529 plan to do that. If you have someone in your family or that's getting involved in an apprenticeship program or a training program to be a plumber, electrician, something along those lines, you can use money to pay for that. This is all new. This wasn't the case before. So licenses, certifications, all good. I think we're going to see more people creating these 529 plans even for themselves, and then using those funds to pay for things that are necessary and were not permitted to be covered by 529 before. One of the biggest changes for wealthier people who have gains is the very good news that they have continued and expanded the Opportunity Zone program. What's happening now? Beginning of January 1 of 2027, there'll be new opportunities to invest in these opportunity zones. Pay attention to the date. Obviously, it's not 25 or 26, but it becomes very crucial how you're going to work on the timing of this issue. You'll see what I'm getting at in just a moment. If you recall, the way the Opportunity Zone Fund worked when the 2017 Act was passed, if you had a capital gain, you had 180 days, 6 months, to take your gain and invest it in an Opportunity Zone Fund. And if you did that, you were not required to pay tax in the year that you realized the gain. And the gain would only be taxable if you sold the fund or 5 years elapsed. So what they said was, the original law said all the deferred gains would be taxed as of December 31 of 2026. So if you were fortunate enough to invest in an Opportunity Zone Fund in 18, 19, 20, you got a very nice deferral. That's important. But keep in mind, if your clients did that, 2026 is the year of reckoning. That did not get extended by this new tax law. So we still have the issue that in 2026, your clients are going to be paying tax on more money than they may have earned that year. That deferred gain is out there. If they deferred the gain for at least 5 years, they got a 10% reduction in what the tax would be imposed on that gain, but they still have to pay 90%. They didn't extend that. So people who had this gain prior to 12/31/26 would have this tax due. And if you didn't get the 5 years of holding on to your Opportunity Zone Fund, you don't get the 10% reduction. What did they do in the new law? They rolled this 5-year forward. So going forward now, when you invest, if you invest in an Opportunity Zone Fund with your gain, you can defer that gain for 5 years. So whenever that gain is realized, you've got the 5-year deferral, but subject to a very important limitation. What is that limitation? You have to deal with this in a very careful, timely manner. The rule has been retained and expanded. You keep the fund for 5 years, you lose 10% of your gain disappears. As a sideline, they've also introduced something new called a Rural Opportunity Zone Fund, that if you invest in that, and this is to try to have smaller parts of the country areas get more investment, if you invest in that and you hang on to your fund investment for 5 years, you defer 30% of your gain. And we'll be seeing in another year or so, they'll be introducing what these qualified rural zone funds are. Very importantly, one of the most important aspects of this, if you invest in the fund, you get the deferral of your gain for 5 years. And if you hang on to that Opportunity Zone Fund investment for at least 10 years and then sell it, your tax is zero. You pay no tax on any gain you realize in the Opportunity Zone Fund sale. So it's very desirable. Your clients make gains in many different ways, as you know better than I. You sell things, you do real estate, stocks and bonds, whatever. You realize a generous gain. If you're interested in investing in an Opportunity Zone Fund, that gain is deferred, and ultimately the fund sale could be taxed at zero. Now let's pay attention to the key planning situation. When does this incentive take effect? As I said, January 1 of 2027. So if you realize a gain at the end of 25, you have 6 months to get into the Opportunity Zone Fund. That puts you into it in 26. If you invested it in 26, and you invested in the first half of 26, your 6 months end up still in 2026, and your taxes due on December 31, 2026, a year end. So doing this now, doing this in the first half of 26 will not get you the tax benefit. But now think of bridging the 26 year into 27. Your client realizes a gain in the second half of 2026. The 6 months end in 27. Now you're in the new tax law. You wait till January, February, whatever your 6-month deadline is, find the opportunity zone fund in 27, make the investment. Now you're under the new law. Now you get the benefit of 5 years from the time you make the investment. You get the deferral of your gain with the 10% reduction of your gain if you hang in for 5 years. And now you're in the opportunity zone fund. And if you keep it for 10 years, you're going to have a tax-free benefit. So this is all important to be thinking about. And a further planning issue is it's easy for me to say, oh, defer your gain. Well, maybe that's not quite easy for the client to do. The deal is hot and you have to decide what to do. So maybe, I'm suggesting a few maybes, maybe it's possible to, if it's real estate, maybe enter some type of like-kind exchange where you defer the gain. When you dispose of property 1, you acquire property 2, but the like-kind exchange defers your gain. Then you sell property 2 in the second half of 26 or later, realize a gain that you actually realize, then the opportunity zone fund investment will work. Possibly some type of an installment sale election where you get no money in the first year. Or maybe there's some way to use options. Maybe you dispose of the property and you acquire some type of an option so that your gain is deferred into the second half of 2026 or later. Easy to bring these things up, but maybe you have a situation where that deferral is possible. Another major advantage of the 2025 law is the expansion and the continuation of the opportunities that involve qualified small business stock. This is an enormous planning opportunity for people who are able to take advantage. What do you need to do to take advantage? Well, there's a number of things. The way I describe it is you have to have your stars line up in the right direction, and then this can work. So the first thing you need is a C corporation, not an S corp, not a partnership, not an LLC, a C corporation. Assuming you have one or you create one, that's step one. You cannot be in a service business, though, to have this work. So lawyers, accountants, wealth managers, doctors, performers, et cetera, none of us can take advantage of this, unfortunately. But assuming you're not in a service business, you are eligible to take advantage of this. So we start with a C Corp, not in a service business. You have to have 80% of your assets in an active business, so no passive investments, no rental property in these situations. The law that's been in effect for a long time said that if you held on to this stock for 5 years and you acquired it after September 28th of 2010, you got a tax exclusion. There were other exclusions between 1993 and 2010 where you got 50 or 75%. So what have they done now? They have created a new structure for this exclusion. But key date, the stock has to have been acquired on or after, probably after July 4th, 2025. That's when this new law became effective. So a C corporation, not in a service business, stock acquired after July 4th of 25, this new provision is available. So what does this new provision mean? Well, now they've changed the holding dates. If you acquired it and held it for 3 years, you can exclude half your gain when you sell. If the stock is held for 4 years, 75% of the gain. For 5 years, 100% of the gain. How much can you exclude? You have a couple of thresholds here. You can exclude, used to be capped at $10 million. Now it's $15 million. And 10 times your basis is also available. So the greater of $15 million or 10 times your basis is what the amount that can be excluded, assuming the C Corp stock is acquired after July 4th of 2025. Is there a cap on how much you can invest? Yes, it used to be $50 million. Now it's $75 million. That will be indexed for inflation. So at the maximum number of $75 million investment held for 5 years in a C Corp and the stock is sold, 10 times that, $750 million. Tax-free. That's an amazing planning opportunity in these plans. So what is that going to suggest? enhancements to this law may push some S corps to be organized that would have been organized as S corps or LLCs might be C corps. The 21% tax rate on C corps is fairly favorable. So these are things that we're going to see more aggressively pursued by our clients. But think about it. This is an amazing opportunity. And people that have an S corp now, you can convert it to a C corp. Your 5-year clock starts when you convert to a C corp. LLCs can be a C corp. I had a situation, just as a quick example, a group of people that own a pharmacy company, that sort of the middle person of the pharmacy company. They acquire medications from the provider and they sell them to the drugstores. That's not a service business. They're selling a product. They've converted their LLC to a C corp after July 4. They have a great expectation of significant profit. These folks are all in their early 60s, the owners. There are 4 of them. And so each of them is hopeful that they hang in for 5 years, that at the end of 5 years, they sell this for a significant profit, and that profit will be 100% tax-free. They will then all retire and play golf, go to the beach, whatever it is they want to do. I mean, that's a wonderful planning opportunity, something to give some thought to if you have people not in that service business. The mortgage interest deduction has been capped. That's permanent now. They started this in the 17 Act. You get $750,000 of acquisition debt. You can deduct the interest on that. But if your acquisition debt is greater, no, you can't deduct it unless you had $1 million of debt prior to December 15th of 2017. Then you can deduct the interest on that million. Home equity debt is permanently eliminated. You can't take out a home equity loan to pay off your credit card debt or your car loan or anything like that. Unfortunately, that's gone. Miscellaneous itemized deductions were suspended in the 17 Act. Now they're permanently eliminated, except for some educator expenses, teachers, and some coaches, etc. So that eliminates, unfortunately, what our clients complain about even when they could deduct it: legal fees, accounting fees, fees paid to their financial managers, investment advisory fees, employee business expenses. All those are now permanently eliminated from the tax law. That used to make a lot of us pay alternative minimum tax because we were paying a lot of those expenses. That limited AMT issues, but we'll see where that goes now that the SALT limitation's been increased. The Act also said personal casualty losses are only those where you have a federally declared disaster, but they did expand it to state declared disasters. Sometimes there's a local flood or local issue that maybe the federal government doesn't take notice of, but the state does. Now you can deduct your casualty losses in those circumstances. So that's favorable. But a personal loss, if someone breaks into your car and steals your gym bag or your purse and gets your jewelry, your watch, your phone, that's too bad. That's not a declared disaster. Personal exemptions, no longer deductible. From the 17 Act, that's permanently now no personal exemptions allowed. Some of your clients may be involved in businesses where they invest in machinery, equipment, a wide range of expenses. The very good news is the 100% bonus depreciation is back as of January 19th of this year. That was Inauguration Day. And so clients that had been limited to a much lesser percentage because the 17 Act gave us 100%, but then it got withdrawn 20% a year for a few years, back to 100%. Section 179 depreciation, depending on the type of property you're investing, also increased, and 100% bonus for what's called qualified production property, which is non-residential real estate used in manufacturing. So if you have some of these things in your clients, you're going to see your clients are going to have much larger deductions available if they're in any of these business situations, which means they may have more money to invest in stocks and bonds and other type investments because the government is subsidizing their their business investments. So just things to watch for if you see clients in the businesses investing some of their money in these deductible expenses. So all interesting things. Let's talk about a very important planning suggestion that we're making to a lot of clients now. Consider a Roth conversion. A Roth conversion means you take your retirement plan and you convert it to a Roth IRA. It is a taxable event. You might be in the top tax bracket, or you're in some tax bracket, so you're going to pay income tax voluntarily. You don't have to convert to a Roth. But if you choose to do this, what are the advantages? One thing we look at is what I call buckets. There are many tax brackets, so nothing requires you to convert your entire retirement plan to a Roth in 1 year. Look at your tax bracket. Where are you without doing a Roth conversion? And if you put money into the Roth, where will that put you? Stop at the top of the bracket before you reach the next one. All right. Why am I suggesting this? I've been doing live programs around the country the last few months, and every time I do one, I ask the audience, how many of you think the next 10 years will see lower or higher income tax rates? There are no hands going up for lower. That most of the hands go for higher, assuming all these folks are still awake. So higher seems to be the idea. So if we're thinking about that, think about your IRA, your retirement plan. The income tax is like a mortgage. Client says, I have a $5 million retirement plan. I say, well, the government's going to get 40% of that, maybe more in states with high income taxes. So maybe your retirement plan is really worth $3 million. And if the tax rates go up, what's going to happen? Well, you're going to pay more on your own money. So that's a concern. Also, sadly, if one spouse dies, a married couple, the surviving spouse will still have the ability to withdraw those funds, but now they're in the single bracket, not the married joint bracket. So the future only suggests higher taxes on your retirement plan. Once you turn age 73, you hit the required minimum distributions for the rest of your life. You'll be claiming Social Security by then, maybe sooner, but certainly by then. So the sum of the tax you're going to pay on your Social Security plus the tax you're going to pay on your required minimum distributions, you're going to be in the highest tax bracket for the rest of your life once you hit this point. Maybe you're not there yet. Maybe you're in your late 50s, beyond 59 and a half, so very late 50s, preferably 60s, or maybe right around 70, and you haven't claimed your Social Security yet. You're waiting until 70. You're not required to take your RMD, but maybe you're not getting that high compensation you got before. This is the perfect time to be thinking of the Roth IRA conversion. What downside might there be? Well, one downside might be if you're eligible for the $6,000 deduction, for the senior deduction, it's phased out. And if you're close, maybe you don't do a Roth conversion that puts you over. Maybe you're involved with the SALT deduction. Maybe your income is under $500,000. In the year that you convert to a Roth, you may get pushed over $500,000. If you're over 600, your SALT limitation is capped at 10,000. So pay attention to those negative aspects of having too much adjusted gross income, but that might only be for 1 year. So think about the conversion. I call these the bridge years. Your compensation may have decreased or been eliminated by a chosen retirement in your 60s, a forced retirement because your company insists you retire in your 60s. Take advantage of the current tax rates. They're probably not going to go down. What else happens? You put your money into the IRA, you do the Roth conversion. When do you have to take your money out? Never. You're the participant. When do you pay income tax on that money? Once you've done the Roth conversion, never. So the money stays in your Roth. Maybe you're fortunate enough, you don't have to take any of it out. You live on other money, other retirement money that you didn't convert, other interest, dividends, gains, etc., that your wealth managers are doing a great job managing for you. All right. Then you die. Your heirs have to take the money out. When do they have to take it out? Any time within 10 years of the participant's death. And when they take it out, it's income tax free. So ideally, if your children are of an age and of a level of income where they really don't need this money, They can wait 10 years. They can take it out incrementally. They can take it out any time. But let's say they wait the whole 10 years. The money may double in 10 years. And again, it's all tax-free to them. The other advantage is if you have a large estate, your client is over the $15 million exclusion, and maybe that number will go down in the future as well, but they have a taxable estate that you can count on. By paying the income tax on the Roth conversion, they have less money. And so their future taxable estate has now declined. So all these things are important. Estate trust and tax planning were a few things to mention here. The exemption is $15 million beginning next year to be indexed for inflation. That is still with us. They say it's permanent. We know that political change might affect that. But right now, it's available. They didn't change the rule that said when a person dies, the fair market value of their assets becomes the basis to the person's heirs. That does not apply to what are called IRD, income in respect of a decedent items. Those are retirement plans. That's the biggest one. Installment sales, things like that. But for all your other assets, your investment account, your brokerage account, your real estate, fair market value at death becomes the basis. Will this be the law forever? We don't know. So my point here is take advantage of it while you can. Sophisticated estate planning for wealthier people. There are great techniques that are available. We can use all of these things. A spousal lifetime access trust that we call a SLAT, the intentionally defective grantor trust that we call the IDGIT, multi-generational trusts, dynasty trusts that have some states let you do this forever, some for hundreds of years, some for 1,000 years. So pick the state with the trust that lets you have a trust for your family that will never, ever be taxed again under current law unless the money from the trust is distributed to the beneficiaries. A grantor retained annuity trust is another planning opportunity. All of these things accomplish, one, the use of your exclusion while it's available. Two, the ability to freeze the value of your estate at its current level. All the future appreciation can belong to your children, and in some of these structures, your grandchildren, with no tax going forward. All this is in the law. All of these things were targeted by the Obama Green Book and the Biden Green Book to be eliminated. Some of you might feel it's about time all these rich people can't take advantage of all this. Others might say, let's make sure rich clients take advantage of this before it might go away. I'm a planner trying to save clients money. So I recommend all of these things in the right circumstances. They all work. One of the things you have to be careful of is portability. Don't miss out on the opportunity that if you're a married couple, spouse A dies, B survives. If A leaves property to B, A has not used all of A's exclusion, maybe used none of it. So by filing a Form 706, a federal estate tax return, the available exclusion, which the law calls the DSUE, D-S-U-E, the deceased spouse's unused exemption, passes to the survivor. So if spouse A dies in 26, hadn't used A's exclusion previously, $15 million ports to B. B now gets that $15 million plus whatever the exclusion is when B makes gifts or dies. Might be lower, might be higher. We don't know the future, but we know the present. And when A dies, 15 million, if it's 26, is available to B. That will not be clawed back if the DSUE numbers goes down. It's not indexed for inflation going forward, but it's $15 million. So make sure your clients file Form 706. If they are required to file the form because their estate is over 15 million next year, they have 9 months to file the form. They can get a 6-month extension. That gives them 15. If they miss that, too bad. No more chance to get this exclusion. However, if they're not required to file the form, if it's voluntary that they require it, they get 5 years from the decedent's date of death. And if they miss the 5 years, they can get a private letter ruling that gives them another chance to file their 706. Portability became available in 2011. So if you have clients that are married and a death occurred sometime after 2011, if the client didn't file the 706, Maybe encourage them. It's worth it now, because who knows where the exclusion goes in the future? Who knows how wealthy the surviving spouse may become? So we want to be thinking about this. We also want to be thinking about what to do with property passing to a spouse. If we give the spouse the property outright, the good news is the spouse has control. The bad news is the spouse has control. Think of a blended family. A and B have children from their own prior marriages. If A dies, leaves everything to B, who's going to get A's property? Will A's children get it? Maybe, maybe not. Even if they're not a blended family, A and B are one marriage, one set of kids. A dies, is B to be trusted to take care of the children of A and B? Maybe B remarries, maybe B has a dementia issue. So maybe trusts are a better idea. We like using what we call the Q-tip trust in planning for all levels of wealth, because the Q-tip trust says the surviving spouse gets income for life. No one else can get the income. A trustee can be given discretion to give the surviving spouse principal. Nobody else can get that principal. But when the surviving spouse dies, the first decedent spouse's plan controls where the property goes. If you're thinking about income tax basis, spouse A dies, fair market value at death becomes surviving spouse B's basis. When B dies, fair market value at B's death becomes the heir's basis. But the downside to that is if the property is appreciated during B's lifetime, that appreciation is part of B's estate. If you go in a different direction, you can use what's called a credit shelter trust to provide a trust when A dies for B, where the property will not be included in B's estate, but the basis will not be fair market value at B's death. And these are discussions that we have to have with clients at all levels of wealth. They're all important. One caution, your clients may have signed documents 15, 20 years ago, and they don't think they need to change them because they say, I have the same spouse, the same kids, the family gets along. And I read the document and it says, I leave the maximum amount that can pass without tax to my children, the balance to my spouse. Well, in 1999, that was $675,000 to the kids, balance to the spouse. That same formula now leaves $15 million to the kids, balance to spouse. So it might be helpful, even if you're not their attorney, talk to clients, maybe take a look at their older documents to see if you would recommend they speak to an attorney to see if changes are important. Pay attention to the state where you live. Some states have no estate or inheritance tax. Great, that could change. Some states might say, well, 15 million free from federal tax, why don't we add a tax to grab some of that wealth? The state of Washington recently passed a law to impose a 35% state tax on the states over $9 million. Add that to the federal tax of 40%, 75% minus the deduction on the federal return for the state tax has an effective rate of about 61%. So these are things to be watching out for. What's your state doing? Where do you stand in these different situations? Our clients have life insurance. What should we do with it? We should see if they want to keep it. They may not need it anymore to pay taxes with these generous exemptions, but these exemptions can go down. So the advantage of an irrevocable life insurance trust is the insured puts the property into a trust. It's irrevocable. The trust is the owner and beneficiary, and the true trust beneficiaries are typically spouse for life, then children either outright or for life. And so done correctly, if the insured lives 3 years from the time they put the policy into the trust, no tax in the insured's estate, no tax in the spouse's estate, maybe no tax in the children's estate. If the person has a taxable estate, when the insured dies, we can use the funds from the insurance policy to buy assets from the estate and pay the tax. Buying assets from the estate's value is day-to-death value, so there's no income tax to be paid, and now we have a liquid fund to cover tax payments. Basis planning is a key to income tax understanding. What's the basis of property here? You make a gift, it carries over from donor to donee. It's not the fair market value on the date of the gift, it's the donee's basis, the donor's basis to the donee. Donor paid $20 for Apple stock. It's $2.75 today. If you give Apple stock away, the donee's basis is $20. If you die, donee's basis is $2.75. So pay attention to basis. Don't let the older family members who have great low basis assets give them away to children and grandchildren. Sadly, death is a better plan here. If they have high basis assets, that makes some more sense. So pay attention to basis issues. Those of you who live in a community property state have the best rule. Your community property is valued at fair market value. Both halves of the property is the basis to the survivor. So A and B have community property. A dies, B gets 100% of the value as B's basis. Jointly held property doesn't work that way. Jointly held property, the survivor gets a basis of half the date of death value and half the original cost. So sometimes we find ways in jointly held property where one spouse might be quite ill or significantly older than the younger spouse. Get the joint property in the hands of the older or ill person. Sounds very cold, but it'll save the family a lot of money. One of the techniques I love to use is called upstream planning. You have an older family member, grandma, grandpa. You give them your low basis assets. Give them the Apple stock you bought for $20 a share. If they keep it for more than 1 year, die, and you get it back at their death, the value, your basis is fair market value on their date of death. All that gain disappears. If they die within the year and you get it back, your basis is continued. So what I try to do here, make sure the older family member doesn't have a taxable estate of their own. Make sure they don't have any creditors chasing them. What I like to do here is if the client says, I don't know how long grandma and grandpa are going to live, what I suggest is have them revise their document and say, if they have it for more than 1 year and they die, you get it back. If they have it for less than 1 year and they die, your children get it. Your children didn't give it to them. Your children get a fair market value on their date of death. They're not the donor here. So all this planning makes sense. Sometimes we go the other way. We do downstream planning. We make gifts to children. Be careful of the kiddie tax. If they're under 19 or full-time students under 24, it may not work because you're taxed at the parents' rate. But if your children are not subject to the kiddie tax, they get their own $40,000 SALT limitation. They may be in a much lower income tax bracket. For regular income, for capital gains, they might be in the 0 or 15% bracket, not where you are in the 20% bracket. And if you do this, you may get your own income below $500,000. You may get the ability to remove assets from your estate. And a great plan, if you have that 1202, that qualified small business stock, if you give it away, everyone that you gave it to, or if you die and leave it to people, every heir, every donee can take advantage of that $15 million tax-free opportunity. This is really interesting planning. We use general powers of appointment to build basis by saying, I'm going to give an older person or someone, a trust beneficiary, a general power. That means it'll be in their estate. I don't give it to them up front because I don't know what the future will be, how big their estate will be, what the law will be. But I create a trust where the trustee or the trust protector can grant that general power of appointment. If that's the case, the property subject to the power is includable in the person's estate when they die, and the heirs get a fair market value at death basis. Your clients are business owners. Think about moving assets to the younger generation. Maybe you don't want to give them voting stock, voting, non-voting stock. Okay with C Corps, okay with S Corps. S Corps can have non-voting shares. They can't have any other differences between the shares, but voting is allowed. My favorite technique is the IDGIT, the defective grantor trust. You freeze the value of the wealthy person's assets at today's value. All the future appreciation belongs to their children or grandchildren. The senior generation pays the income tax. That's not a gift. They're obligated to pay it, and they reduce their estate by the income tax payments. Bottom line about the federal tax, clients don't want to pay tax. They don't have to. Leave your exempt amount to your family and leave the rest to charity. Clients say, well, what else have you got? A very valuable technique to be aware of is called the charitable annuity trust, where you can set up a trust at death and you can create a tax deduction for the amount that's going to pass to charity. Charity will come first. Charity gets a trust distribution every year, and you can have that annual distribution be equal to the estate tax owed by the decedent. At the end of the day, the family gets the exempt amount when the client dies. At the end of the trust term, they get what's ever in the trust. And if your wealth advisors do a good job of preserving the value, the family gets a substantial payment at the end of the charitable trust's interest, and the tax on that is zero. You got it zeroed out by your tax deduction when the client died. We've come to the end of the program. There is an amazing amount of planning that works. We have had the golden age of tax and estate planning for the last 20 plus years. It's still with us. It's still with us at least to the next election and maybe beyond. But don't be the client advisor that waits and sees what happens and tells the client after it's happened. Be the advisor who says to the client, there's a lot of opportunity now. Try to take advantage of it while it's with us. Who knows what the future brings? With that, thank you, RVW Wealth. It's always a pleasure. Thank you, Solomon.
Thank you. Thank you very much, Steve. A masterful presentation. I think there was something here for everybody. I hope you benefited greatly. Just a couple of final points in addition to thanking you and everybody. Firstly, we do have a complimentary guide to year-end tax and estate planning. If you send an email to anybody on the team, we'll be happy to send it to you. It's quite comprehensive and very user-friendly and action-oriented. So that's the first thing. The second is I wanted you all to know that we have received a very significant honor over the last couple of weeks. We were nominated by Forbes magazine to be one of the top RIAs, registered investment advisors in the country. That is an honor that we really treasure because we think our clients love and appreciate us, and that's very nice, certainly our family members and our team members, and that means the world to us. But when an outside agency that looks at everything of everybody and comes to the conclusion that we're worthy of that award and recognition, that is extremely meaningful, and we're humbled by the honor. So with that, I wish you all a wonderful Thanksgiving. We have much to be thankful for in this glorious land. Enjoy the time with your family and those you love, and we'll see you again soon. Thank you very much.